So Dinesh, just to bring the group up to speed with some of the terms that we very often use in this venture capital and private equity funds, can you talk about the various stages of investment?
I got that. Yeah. I wanted to talk about also the stages of fund, where funds target, meaning what is a seed stage, what's an A. So maybe I'll do that. And then I also talk about typically what kind of businesses are equity funds interested in investing in, right? So in terms of the stages, there's typically a seed stage, which is, to take archetypal example, two guys in a garage. I mean, the old two people who come together, they've got a great idea, they're just starting out. That's seed stage, right? And that's typically funded by friends and family. You get started with a small amount of capital just to get you going to where you have some proof of concept. Then you get to, so that could be funded also by angels. I mean, those individuals are typically called angel investors.
Ticket size would be in the region of?
Could be as little.
So that's 10 lakhs.
Yeah, exactly. Could be 10 lakhs to 50 lakhs, right? Yeah. And the idea is to just get you started to where you can prove, you have something to prove. Either you get a first customer, or you build a demo of a product, whatever, enough to where you can go to the next stage, which is a Series A, where you're saying, hey, the idea has a little bit of substance behind it. It's not just I've sat here and did PowerPoint. It's taking PowerPoint to something a little bit more tangible that says, hey, there's something here, right?
Sorry, and what is the exit that these people are looking in?
So at the seed level, because the gestation period is so long, right? So first of all, gestation periods everywhere, I mean, it just takes time to build a business. But that's the other aspect that we've seen in India. It links back to my comment about exit. I was talking to a venture capitalist who has now been investing. Some of their companies are in their 14th and 15th year, and they still don't have exits. And these are successful companies that you and I both know. I use the product. I go to the website and I use. So it's not that the business isn't, but it just takes a long time to scale here. So in keeping that in mind, and typically no one wants to keep their money locked up for 15 years. So the seed investors by then have usually exited by selling on to the Series A or the Series B, right? Of course, you give up the potential upside, but as I said, there are very few companies that actually get that kind of huge exit, right? The most famous, or one of the most famous, is Ram Shriram, who you may have read about, who made, I don't know what he finally did, what he retained, but when Google listed, his stock was worth over $1 billion, right? Because he came in at the seed and he stuck it out. So that's what you can do, but more often than not, you end up exiting earlier. So you go to Series A, right? And Series A could be typically anywhere from, and I'm quoting dollars because unfortunately most of our capital is still dollar driven. I'll talk about a few domestic funds, so I'll provide some names as well. But I put dollars because that's how they think. In fact, I was with one of the venture capitalists yesterday discussing a company, and I kept talking crores and he kept talking millions of dollars, right? So typically they would be sort of, it used to be 2 to 5 million, and now that Series A has moved up to more like $8 million, right? So in other words, for them to come in, they're already seeing that there's some traction that you have. And this is the next stage. And then, of course, you have a Series B, which is typically more what we call growth capital, which is the business model is sort of set now, the product is working, the service, whatever it is, and it's just a matter of scaling. Meaning, hey, it's worked in India, and now we're going to take it to the US. Or I have distribution of my product in 3 states, and I'm now going to take it out nationwide. I mean, so there's nothing fundamental. The business model is largely baked. It's now a scaling issue. Right? And of course, you can have Series C and D. I don't want to get too into that because that's a new trend that started in Silicon Valley, where instead of going public, a lot of these companies like Uber and Flipkart have, because there's so much private capital available in a way, they are choosing not to list, and they're choosing to take private capital and just keep growing. and then do a big gargantuan listing as happened with Alibaba, right? So those are the stages of funding. And I can certainly, I mean, I won't go through a laundry list, but if there's interest, I can subsequently give names of firms that, I will talk specifically maybe about a few firms that are rupee capital based, domestic, might be more interested in services and manufacturing. But let me table that. Now to come back to what are people looking at, what kind of businesses? They're typically looking at capital light, high return on capital businesses. That's really what people, and that's why high growth and capital efficient companies. And which is why technology has been sort of the poster child, if you would.
And asset light.
Asset light. So high return on capital effectively means you have to stay, So high growth, high return on capital businesses is what they look at, right? And typically whether it's not a linear model, so it's saying if I want to get 100 to 200, it doesn't mean that I add double the amount of headcount, or they're looking for some exponential growth there. So that's the most common type of business people look at.
The second is where, and this is more private equity oriented now, where it's a reasonable growth, but not 100% growth. We're talking 20% growth. I'm just making these numbers up, but it's a steady cash flow business. So people can see, it's growth, but I'm reasonably assured that I will, that this business will keep compounding. So it's at a different point on the risk spectrum. So their expectation on returns are also lower. The way the venture model works, I'm not sure if you're familiar with this. The way the venture model works is that for every 10 companies that they invest in, there'll be 1 or 2 that just go bust. You just write off your value. There'll be maybe, if you're lucky, you'll get one that's a multi-bagger that will return 10 times. And then there'll be, and more. And then there'll be sort of the middle ground of they range from the living dead, meaning they're sort of getting along, they're not shutting down. Particularly services businesses, we see this. There's enough cash flow to keep it going, but it's not growing. It's not, and back to my point about exit. How are you going to exit? Yeah, they're surviving, so it pays your bills, as entrepreneurs, but there's no great exit for the and that's how it works. It's a hits-driven business. It's like the movie business. There are plenty of movies that don't make it, but those few that pay for everything else. The PE model is different. They can't afford to take write-offs because their winners typically are returning 3-4x. So they can't afford to take a complete write-off. So they are playing lower down the risk spectrum. Lower growth but steady state, more steadier state. And ticket size is typically much higher. Right. So I'm going to stop at that point and sort of open it up to questions. And of course we can address the ones on the list as well, but instead of my talking all the time, let me just stop and open it up.
So Dinesh, a couple of things to set that tone. We got interesting mix that you would have seen. There are those who are at cutting edge of new models coming in. There are those who are fairly established businesses. There is this big, when it comes to venture capital, especially the earlier stages, in many ways sort of respectful.
Yeah.
They know what they're getting into.
Yeah.
Right? So I was looking at Northwestern's recently banking. And his take was that if anybody out there who is just calculating IRR, they don't deserve to do this. They don't,
Yeah.
Contrarian view that is coming in. And your thought, because you've seen both the environments, Valley as well as in India. What my observation has been that in Valley, they ask the question, what can this become?
Yeah.
And here we ask the question, what will this be? Say 2 years down the line, 3 years down the line. And is it because both on the demand and the supply side of mindset is very revenue oriented, very calibrated, and hence many of the people in this environment still not able to digest the forecasts. Right? Because Amazon has been losing money for 20 years or so. How do you see this evolving, given that there's much to be done here. The mindset, both on the investor side and the entrepreneur side, is very calibrated. It's still very straight.
So I would, first of all, I don't do this on a daily basis anymore as I used to. But I also have lots of friends who are in it, so I have sort of second-hand knowledge. And my understanding, and I've looked at, like, the reason I met this venture capitalist yesterday is because we're looking at one of these new gen businesses, high growth, e-commerce, all this stuff. And you know, the company wants to be, you know, their pitch is to be valued at 6 times their revenue.
Sure.
Right? So I'm scratching my head and said, why 6? Why not 8? Why not 4? You know, so, but to address your question specifically, I think that's changed. I think that VCs here, you know, in the last 2, 3, 4 years, I think people have moved away from that show me the money, honey type of thing, right? It's more about what can be, right? And you're seeing that. That's why, you know, people like Flipkart or yeah. So people are, I think, have made that shift. I think entrepreneurs have made that shift, and I think VCs. Unfortunately, that VCs, it's very interesting. It's almost all dollar funding. It's almost all global funds that have seen this work in the US and in China and saying, okay, this is the next China, right? If you look around, there's very little domestic money because the domestic mindset has been more about, okay, show me the revenue growth, show me cash flow. Exactly. So, and I think that approach is still sound when it comes to what I said, the steady growth, you know, 20% growth, you know, that makes sense because you're not aiming for a 100-bagger.